if we had an honest to goodness dollar crisis, gold would have to go up 19x to match the price level it was at in 1980 relative to foreign held treasuries outstanding, which just gives you a sense of exactly how exaggerated the growth in U.S. debt has been and how subdued the price of gold has been since those periods of time. I think the 20 to 40% ratio, right, which is 3x to 6x, like, to me, that's just getting back to the long-term average. That shows you exactly how much debt we have thrown off over the last 40 years.
According to Luke Gromen, founder and president of Forest for the Trees, the current price of gold has increased by 30% since November. Despite this substantial rise, the price of gold has yet to fully reflect a potential shift to being the primary reserve asset at the global central bank level. Gormen suggests that for gold to regain this status, its price would need to rise substantially. In the early European trading hours on Monday, the gold price attracted some dip buyers, recovering part of its retracement slide from the 2-week high on Friday. Gold futures saw modest gains, primarily driven by a weakening dollar. The most active August gold contract settled at $2,345.90, up $11.20 or 0.48%. Meanwhile, the dollar index declined by 0.35% to 105.491, contributing significantly to gold's upward movement. Gromen emphasizes that in a severe dollar crisis, gold would need to increase 19 times relative to foreign-held treasuries to reach the 1980 levels. This scenario underscores the immense growth in U.S. debt over the past 40 years and the country's heavy reliance on exporting Treasury bonds rather than other goods. The Congressional Budget Office's most recent report highlights that the U.S. is running a budget deficit of 7% of GDP during cyclical strength and deficient unemployment. The public debt to GDP ratio is projected to reach an all-time high of 122% by 2034. Gromen explains that one way to understand the potential for gold's price increase is to look at the market value of U.S. official gold relative to foreign-held U.S. treasuries. Currently, this ratio stands at just 7%, indicating that gold would need to triple in price to return to the 1989 level and rise approximately six-fold to match the long-term average. Adding to the optimism, a report published on Monday by an analyst at Bank of America forecasts that gold prices could hit $3,000 an ounce in the next 12 to 18 months. Join us as we delve into Luke Gromen's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Gold has barely, even with its 30% move higher since November, call it, has barely begun to reflect a reversion to the mean that, if I'm right about it, returning to being the primary reserve asset at the global central bank level. It needs to be made orders of magnitude bigger in price. And something I've highlighted before for clients has been the market value of U.S. official gold relative to the foreign held treasuries outstanding. That's simply market price of gold times 261 million ounces that the U.S. owns as a percentage of foreign held treasuries outstanding. And so when we go back through history, what we find is the long-term average of that ratio is 40%, roughly, 40%. In 1989, when the USSR fell, the last time we were in a great power competition or Cold War, whatever you want to call it, that percentage was 20%. And when we had an honest-to-goodness dollar crisis like 1979 and 1980, the percentage was 134%. Now, that is a gold bubble. That meant that foreign holders of treasuries could have showed up at Treasury or Fed and said, give us our gold, and exchanged all of their treasury bonds for gold, and the U.S. still would have had a third of its gold left over. That's a bubble in gold. Fast forward to today, this ratio is at 7%. 7. So gold would need to triple just to get back to the very bottom of this range where we were in 1989, the last time we had a great power competition. Gold would have to rise roughly 6x just to get back to the long-term 50, 60-year average of where it traded in that ratio. And if we, like I said, if we had an honest-to-goodness dollar crisis, gold would have to go up 19x to match the price level it was at in 1980 relative to foreign held treasuries outstanding, which just gives you a sense of exactly how exaggerated the growth in U.S. debt has been and how subdued the price of gold has been since those periods of time.
19x gold at its current price now. Only if...
That's where it was in 1980.
Yep. Do the math for me, Luke.
42,000, 44,000. Now, I don't think that's going to happen unless there's an honest to goodness dollar crisis, which I'm not foreseeing. But I think the 20 to 40% ratio, right, which is 3x to 6x, like to me, that's just getting back to the long-term average. Like that shows you exactly how much debt we have thrown off over the last 40 years. We got very good at exporting treasury bonds and very bad at exporting everything else. That's what that tells you. And what I'm telling you is, and who cares what I'm telling you, what Janet Yellen's telling you, what Jake Sullivan's telling you, what the Department of Defense is telling you is that it's a national security interest of the U.S. to get out of the treasury export business and to get into the stuff export business again. But we can't do that without a much weaker dollar. And the arbiter of that's going to be the price of gold, in my view.
U.S. Treasuries are on the brink of breaking even after a roller coaster first half of the year. Throughout 2024, Treasuries have been sent in opposite directions as policy-sensitive two-year yields soared above 5% in April. This spike was driven by fears over higher-for-longer U.S. rates, prompting investors to dump bonds. Adding to the turbulence, China unloaded a record volume of U.S. bonds in the first quarter, escalating its pivot away from dollar-denominated assets. According to U.S. Treasury data cited by Bloomberg, Beijing sold $53.3 billion worth of U.S. Treasury and agency bonds from its stockpile. Luke Gromen asserts that the U.S. Treasury market is losing its status as the primary global reserve asset, with several factors contributing to this shift. Since 2014, global central banks have sold $400 billion in treasuries while purchasing $600 billion worth of gold. This trend suggests a growing preference for gold over treasuries. Let's get back to the interview.
I think the reason why the U.S. Treasury market is losing its share as primary global reserve asset, and we can see that since 2014, global central banks have sold $400 billion of treasuries on net, and they've bought $600 billion worth of gold on net. So from a marginal perspective, for the last 10 years, central banks have bought gold and sold treasuries. The reason I think this is happening is multiple. Number one, for the reasons I just highlighted, some of it's mechanical. When the dollar gets too strong, you sell what you can to raise dollars, not what you want to. That's treasuries. Number two, some of it is geopolitical. Treasuries for central banks are no longer risk-free instruments. If you do something the United States government doesn't like, they will take your treasuries, full stop. They've done it to Russia, they've done it to others, and that has opened eyes. The third point is a little more subtle, but it is in a world where you have peak cheap oil, which is to say we're not running out of oil, but we're running out of cheap oil. It costs more and more to find marginal barrels of oil. When we're in a peak cheap copper world, where, again, we're not running out of copper, but the copper we find, the prospective supplies are much, much higher, and everyone wants to electrify everything, then you can't store the reserves that you're going to need to, at some point as a nation, deploy possibly into oil, into copper, into commodities. You can't store that in bonds. You need to store that in a reserve asset whose value either stays flat or gains versus oil and copper. And gold has a very long history of maintaining or increasing its value in oil, copper, and other commodity terms. For example, in the last 15 years, oil or gold is up roughly 4x, about 3x to 4x versus oil, and a little over 4x against the Goldman Sachs Commodity Index. And in contrast, treasury bonds are certificates of confiscation against commodities in a peak cheap copper, peak cheap oil world. Now, if the U.S. debt load was modest, such that the Fed could credibly say we will raise rates as high as we need to in order to contain inflation and keep treasury bonds as good as gold for oil and for commodities, then we wouldn't be seeing this switch, in my view. But the problem is with the debt at 120% to GDP and deficits at 7% with near or full employment, the United States cannot credibly say we're going to raise rates as much as we need to stop inflation. They can't. The United States government can't afford much over 5 or 6% on the 10-year. We know that. We saw it last fall. So if you've got a bond that can only raise rates so much in a world where the geology of copper and the geology of oil and global growth in the global south suggests that the prices of those things are probably going to go up pretty notably over time, then you better store more of your surpluses, more of your central bank FX reserves in a reserve asset. Number one, that the Americans can't take, which is gold in your vault, not treasuries. And number two, that preserves your country's purchasing power in oil and copper and commodity terms, which is also gold, not treasuries.
Given the increasing volatility in the U.S. Treasury market, the significant sell-off by major holders like China, and the apparent shift by global central banks from treasuries to gold, how will the U.S. government and Federal Reserve respond to maintain the attractiveness of U.S. debt? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.